please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
All right, first up, let's take a look at the Asian markets. What's happening in Asia is actually mirroring what took place in the Wall Street last evening. So the Dow was down about 350 points, and as we speak, the Nikkei is down about 172 points as well. No real change in the currency out there, but the Japanese sentiment is led lower by the decline in approval ratings of President Shinzo Abe, and that is because of the tampering with official documents accusation that has been made, which he recently accepted to as well. The Korean index too slightly under pressure. We'll keep an eye out on the steel space in Korea. That one is holding up, and that's because the street believes that maybe they will be writing to the United States to be exempt from the US tariffs as well. So that is something we'll watch out for. The steel stocks supporting a little bit on the downside for the Korean markets. The electronic stocks underperforming. The Taiwanese as well as the Straits indices should come up for you. Both of them also trading in the red as we speak, to the tune of 0.33%. The SGX Nifty, after a 100-point decline, now indicates that we may start on the back foot to the tune of about 20-25 points. Well, it'll be very interesting to see whether we go back and test yesterday's low of about 10,050 or not.
Yep, so that's Asia for you. And as Mangalam pointed out, it pretty much stemmed from Wall Street because we saw a sharp decline in markets overnight. Shares of Facebook led to the sell-off in technology stocks. This was on the back of reports that social media companies' user information was actually misused. So Facebook shares were down about 6-7%. Now that led the NASDAQ falling about 1.8%. That's the worst drop since the 8th of February this year. Facebook pretty much was leading most of the tech lower. The Dow Jones also fell about 335 points. The S&P 500 declined by about 1.4%. CNBC's Aditi Roy gets us a wrap of all the action.
A big sell-off in the U.S. markets, the Dow losing 335 points, though it had been down much more earlier in the day. The S&P off 39 and the NASDAQ lower by 137. Facebook leading the sell-off today after reports that data from Cambridge Analytica mined information for more than 50 million users of the social network without their consent in order to develop ads for the Trump presidential campaign. Facebook responding today by hiring an outside firm to investigate the reports. Uber is temporarily halting self-driving car tests in all cities after a fatal crash in Tempe, Arizona. Programs in San Francisco, Pittsburgh, Phoenix, and Toronto were paused after a woman was hit and killed while crossing the street overnight. A vehicle operator was present in the car. Twitter plans on becoming the latest advertising platform to ban ads related to cryptocurrencies. The company has not yet formally announced its planned policy changes, which would follow similar moves by Facebook and Google in recent weeks. And that's the action from the U.S. market. Back to you in Mumbai.
All right, interesting developments in the modern tech world there. Facebook data breach, Uber self-driving car meeting with an accident, and Twitter banning cryptocurrency ads. But let's move on to some important old world data to track. The two-day FOMC meet begins later today. This will be Jerome Powell's first meeting, and most investors expect the Fed to announce its first interest rate hike of 2018. However, market will also be looking for signals on whether the officials may step up the pace of rate increases later this year or not, especially given the wage increase that we got, which was below expectations.
All right, let's move on now in an exclusive conversation with CNBC on the sidelines of the 21st Credit Suisse Asia Investment Conference, which is underway in Hong Kong. Former RBI Governor Raghuram Rajan talks about the risks to the U.S. economy and what it should do about its fiscal deficit.
If you look at the U.S. current account deficit, which is how, or even the trade deficit, which is how the U.S. measures itself, given that the U.S. is close to full employment right now, and given that there's a fair amount of stimulus coming through the tax reform, it is likely that the U.S. is going to run a large fiscal deficit, and that's going to spread into a current account deficit and a trade deficit. They're going to spend more on goods from abroad. If that's how they measure their success, well, things are going to get worse because they're going to see that the trade deficit is going to expand. And it's not because others are cheating, it's because the U.S. will be consuming more of foreign goods.
You've got more 30-year conventional mortgage rates at their highest in many, many years at something like 4.75%. People don't know where the story is going. Won't that translate into reticence or a pullback in spending habits and exactly what you're referring to?
It could, but consumer sentiment is very strong even now, despite.
But sentiment and actually doing are two different things. You know
possibly, but it's not just consumption which is picking up. Investment has also been picking up. And investment spending goes in capital goods, a lot of which are manufactured elsewhere. So given that total demand could well go up as a result of the stimulus.
You know, presidents over in the U.S. have for too long overlooked the trade deficit. Now we've got an administration that says we're not going to let this go any further, and yet they've tied it directly to the prosperity, which seems like, based on what you're saying, you say they've got it all wrong.
Well, I think the metric is wrong. I think there is scope for negotiating some of the barriers to entry for U.S. goods elsewhere. That's a conversation that could be had, should be had. But in terms of measuring how you perform based only on manufacturing seems an overly narrow view of what the U.S. should be doing. For example, the U.S. is one of the largest, if not the largest, service exporter in the world. Now, as you may recall, in the recent conversation with Canada, that has been left out of the picture. So you cannot look at narrow measures and argue that this is how we should be measuring our performance. The U.S. is incredibly competitive in some areas of manufacturing, incredibly competitive in services, but not so good in the old manufacturing, the legacy manufacturing. And I think the issue is, how do you move the workers in legacy manufacturing to some of the more resilient areas in the U.S.? That is what their focus should be on, rather than thinking about barriers.
All right, important comments coming in from Raghuram Rajan there, but let's shift focus to the European markets out there. Across the indices, across the board rather, the three big indices closed lower as investors were slightly jittery ahead of the Federal Reserve meeting, which is likely to hike interest rates. But there were some political developments as well. It was announced that the UK will remain within the European Union until the end of 2020, but with restricted powers. Negotiators from Britain and Europe are meeting in Brussels for the Brexit talks ahead of a EU summit later in this week. But there was some pull-out of money seen from the emerging market space as well. The Russian index was down by about 0.6%. The Brazilian index was down by about 1%. Remember, we saw cuts come by in the metal stocks or the metal prices as well. Maybe that would be hurting sentiment in the Brazilian index.
And well, what Mangalam is telling us about the Brexit contours, that really had its fallout in the currency space as well. First up, the dollar. Greenback's largely been holding steady, recovering just a little bit from the overnight lows that we saw ahead of the FOMC meeting. Meanwhile, the euro strengthened following news that the European Central Bank was steadily focusing more on a discussion on future interest rates. And it was the British pound sterling, that actually jumped because of those Brexit negotiations that seem to be on track for now.
In the world of commodities, crude oil prices fall as investors remain wary of growing crude supply, although tensions between Saudi Arabia and Iran gave prices some support.
From the precious metal space, gold prices recovered following weakness in equity markets. However, investors are awaiting the Fed forward policy guidance stance from the two-day meeting, which of course kickstarts later today. Welcome back. You are with Power Breakfast. On to the market action from yesterday. Records were tumbling, but on the southern side, obviously, on the street. In fact, we saw pretty heavy selling in the last hour, and that took the Nifty firmly to the lowest levels for the year. We saw the index, of course, dip below the 10,100 mark as well. The Sensex breached the 33,000 level with cuts of over 250 points. Mid-caps underperformed. That index lost over 300 points. Banking stocks were weak, metals were weak. Pretty much the entire market was down and out yesterday. So how are we looking all set this morning, Mangalam, as we discussed? I don't know. I think the bears would have an upper hand, you'd say?
The bears do have an upper hand, but let's see what happens in today's trading session, because now the Nifty is below all its moving averages, the 20-day moving average, the 50-day moving average. 100 as well as the 200-day moving average. So it'll be interesting to see where do we find some sort of feed for our markets, or is it just a free fall? Because from Jan 29th, where we hit the record high, the Nifty is down almost 1,000 points. The Sensex mid-caps as well as the Nifty Bank down anywhere between 3,000 to 3,500 points, down anywhere between 12 to 14%. The Nifty and the Sensex itself are closer to that correction zone of 10%, 9.6, 9.7 if you must, from the record highs. And why is that? Because the PSU banks, they're down about 23%, lost a quarter of their market cap in just the last 1 month, as well as the Nifty Metals Index, one of the pockets which was outperforming all through last year, has corrected about 14% from the highs as well. The bad news doesn't stop yesterday with our markets stopping as well, because post our markets we got the global cues coming in. Dow Jones down about 1%, the Nikkei down about 1%, as well as the SGX Nifty indicating a cut of almost 20-25 points on the negative side. So that is something we'll have to watch out for. You know, over the last 1.5 months, the sentiment has been soured by a various amount of bad news. It started with the budget, LTCG tax souring sentiment. Then we had PNB, Nirav Modi fraud. Then we had the global yields rising, the global markets weakening, and then to top it all, we had those trade war concerns. So that was perhaps, you know, one of those straws that cracked the back of the camel. If
and politics, domestic politics, let's not forget.
All of that was there, yes. So let's put a number to that. You know, all of 2017, there was 45 lakh crores worth market cap addition to the BSE listed stocks. In the last 1 month itself, we've given up and we've lost about 12 lakh crores in terms of market cap. But what really stood out yesterday, post markets, was that the institutional inflows, they were positive. The FIs bought about 300 crores. The domestic institutional investors sold about 200 crores, telling you that maybe yesterday's fall was on account of some HNIs pulling out some money ahead of the LTCG tax regime, March 31st. Until then, maybe we can see some bit of selling. There was protection buying in the option space. Long puts were added, short calls were added. Let's watch out for a couple of levels. 10,000, of course, is the next psychologically important level at the lower end. And at the higher end, I'll be watching out for 10,180, which is now the 200-day moving average. One would say, you know, at what level do valuations become attractive? At peak, we were about 19 times 1 year forward earnings. Now we're 17 times. But then again, that implies a 25% earnings growth. So let's see where people find value and feet.
Okay, let's see who hits the buy button first. That's what it's all about, I guess. What about stocks? What's on top of your mind now?
A lot of stocks, you know. I'll watch out for PSU banks. The kind of drubbing that they took yesterday. Bank of Baroda, for instance, the last hour of trade fell about 8%. So let's see what happens out there. Is there follow-up selling or not? And in a similar vein, I'll also be watching out for the metal stock. Tata Steel sale is in FNO ban. NMDC did not announce a dividend. So those are a couple of things that we'll be watching out for. Future retail, future group stocks have been a buzz lately. FII limit in future retail has been increased from 24% to 49%. Need to know how much that moves the needle, because as of December 2017 itself, the FII has held about 17% in the company. Race for Binani Cement. Now, you know, this battle is constantly in engaged mode. So we have Ultratech and Dalmia Bharat, both of them in focus. Let's see what happens on that story too. Narayana Hrudayalaya, they've commissioned a new hospital in Gurugram. So let's watch out for that stock. Entering FNO ban is Reliance Communications. Exiting FNO ban today is Bank of India as well as TV18 Broadcast, of course, with the standard disclaimer that it owns the company and the channel that you're currently watching. Aviation stocks, looks like people are not stopping their travel even in February, which is a short month. We saw a 24% increase in passenger traffic out there, and that is the highest that we've seen since December, January, Feb. It's only increased. That trend should come up for you on your screen. REC has been weak in trade, so the board will meet on March 22nd to consider fundraising options. Take Solutions, they are looking to issue some warrants or shares to the promoters on a preferential basis, so watch out for that. Mangalore Chemical and Zuari Agro, these are stocks I'll be watching out for, because the promoter of Mangalore Chemical, Zuari Agro, has released 17.92% equity, or the pledge on 17.92% equity. And finally, this is the last month of this fiscal, so a lot of order action taking place. BGR Energy bagging orders worth nearly 88 crore rupees.
Okay, so that's a long list to keep us busy, along with, of course, the overall market. Let's move to some market opinion as well now. And this is a word coming in from Manish Sonthalia of Motilal Oswal AMC. On the road ahead for the Indian market and, of course, the sectors that he likes. He feels that the risk reward is actually more favorable in favor of mid caps and small caps rather than large caps at this point.
Really, maybe a 5% more downside is possible on the headline numbers. But my sense is there's excesses getting created on the mid-cap and small-cap side in these sort of markets. So, you have seen deep cuts. The silver lining is that the earnings revival is underway. You are seeing multiple compression. But all the negativities in the markets, whether it be the March syndrome or whether it be, let's say, losing of buy polls in some of the states, or whether it be raising of interest rates, I mean, to a very large extent, these things have got played out in the mid-cap and the small-cap names. I think people are finding it very complacent to log into large-cap names, but I think the risk is clearly on the large caps as opposed to the mid-caps and the small caps currently. This calendar year is already a down year. We are underperforming major global markets. So, but I mean, the whole point is, you get to a point where you can't fall any further thanks to earnings revival. In the past, moderate increase in interest rates along with earnings cycle growth has worked positively. So my sense is we are still in, I mean, there's still maybe 9 months to go for, for this year, this calendar year. I would tend to think we'd still have a positive year. Maybe the first half, due to a whole lot of issues, you could see some negativity. But I think once earnings cycle momentum gets reflected fully, you'll start to see that get factored in the markets. I find comfort in the consumer names, the IT, pharma, agri, cement. These would be some of the names which I think will do well over the next 2-3 years, but you've got to wait. It's not that you buy today and you got to start seeing an uptick tomorrow. There's little downside in many of these names which we are seeing currently. People are underestimating the earnings growth on many of the consumer names as we go into the next 1 to 3 years. That's not fully reflected in the valuations, and valuations have also corrected 15-20% in many of these consumer names.